One of the reasons that Austrian economics has seen increasing attention from intellectuals since 2007 is its relevance for understanding the housing boom and bust and subsequent recession. Specifically, the Austrian theory of the business cycle forms the core of that explanation. When the Austrian theory of the cycle is combined with an analysis of U.S. housing policy during the decade or two leading up to the housing crash, it provides a powerful explanation of what happened and why. Austrians argue, in short, that the Federal Reserve's artificial lowering of interest rates through credit expansion after 2001 created an incentive to invest in long-term assets, and U.S. government housing policy directed that credit into the housing market. Because the lower interest rates did not reflect the real saving behavior of the public, the investments in housing were ultimately unsustainable, leading eventually to the housing crisis. When housing prices fell, all of the other financial assets whose value was premised on rising housing prices saw their values fall as well, precipitating the financial crisis. The responses of the Bush and Obama administrations to the crisis in the fall of 2008 and spring of 2009, as well as other policy failures by the Fed, exacerbated and lengthened the resulting recession. To understand the Austrian theory of the business cycle, we need to understand a little bit about what it is that interest rates do. Interest rates ensure the intertemporal coordination of savers and borrowers. When people want to save more, that expands the quantity of loanable funds available to borrowers and lowers interest rates. In a properly functioning economy, more savings by the public, and meaning lower interest rates to borrowers, means that those borrowers can now take those funds and invest them in capital goods and expand production. They can also take their time and engage in longer-term structures of production because people are more willing to save and therefore more willing to wait for those outputs for later on. In a properly functioning economy, the interest rate coordinates this behavior between borrowers and lenders. What the Austrian theory of the business cycle describes is a situation where the interest rate fails to perform that function because credit expansion by the central bank has created a false interest rate signal. So after 2001, the excess credit creation by the Fed gave banks additional funds to lend, leading them to lower interest rates. But that wasn't because the public was more willing to save. In fact, the Fed's credit expansion was so great that it caused for 18 months the federal funds rate, which is the rate banks charge each other to borrow and lend, to actually be negative if one accounts for inflation. This is a huge incentive to borrow, and to borrow in the absence of real saving to support it. People didn't want to lend, nor did they want to wait for the outputs that the borrowed funds would produce. This situation is unsustainable. The real resources to create the project that the borrowers are beginning to construct simply did not exist. It has to eventually collapse. That's the boom and the bust of the Austrian business cycle. But why was it in the housing market in this particular circumstance? Government policy made housing artificially attractive. In general, the lower interest rates the Fed created make housing look like a better deal. Historically, Austrian economists had argued that during the business cycle boom, the excess funds and the lower interest rate generate increased investment in sort of the productive capital that firms purchase. But in this particular case, it ended up in housing thanks to the policies of the U.S. government. And like those capital goods, housing is interest rate sensitive. So it would make sense that this was one possible way that the Austrian business cycle could take place. So why was housing so attractive? Well, for one thing is the secondary mortgage market. In particular, the existence of Fannie Mae and Freddie Mac, the government-sponsored enterprises. Those two institutions are not bound by a profit constraint, and everyone understood that they would get bailed out if they would fail. What happened was, as mortgage originators created mortgages, they could sell those off in the secondary market, and Fannie and Freddie would buy them up, reducing the risk to those mortgage originators. This made housing look particularly attractive and enabled those originators to create mortgages on very thin paper from borrowers. Other government policy included the push for affordable housing. Government mandates on Freddie and Fannie and other borrowers to ensure that both minority borrowers and borrowers with lower incomes were better able to get housing, made, once again, housing look more attractive. And then all of the financial instruments that were created that were based on rising housing prices became part of this problem as well. Eventually, the lack of real resources to support the new houses that were being built became clear, and the sell-off of houses began in 2006, eventually causing the whole house of cards to fall. One key Austrian insight here is that once that crash and once the recession begins, the best policy is to let the economy adjust to the new reality. The boom is where the mistakes are made. The bust is when those mistakes have to be corrected. Resources were badly misallocated in the boom. We had too many people building too many houses. And that was the result of the key price, the interest rate, that was not accurately reflecting the public's knowledge and preferences. The only way to get resources reallocated better is to allow true market prices to guide entrepreneurs in figuring out where best to use those resources. The various policies that were intended to combat the crisis and recession, especially the bailouts of the banking system, prevented entrepreneurs and markets from making the necessary adjustments to the use of resources, which deepened and prolonged the recession. If one wants an analogy here, one can think about getting drunk and then having a hangover the next morning. When one wakes up with a hangover, one feels terrible not because you made mistakes that morning that made you feel bad, but rather the hangover is the result of the poor decisions you made the night before. That feeling sick during a hangover is your body's way of correcting the mistakes you made while you were drinking. And the best course of action is to let nature take its course and to allow time to heal. That's the same advice that Austrians give when it comes to recessions in the marketplace. Allow markets and entrepreneurs to reallocate resources to where they need to be. The Austrian analysis of the Great Recession makes use of a variety of the school's insights, from the macroeconomics of its business cycle theory, to its analysis of the failures of regulation, to its understanding of the price system, to its theory of entrepreneurship. And this is one reason why Austrian economics is back in the intellectual conversation since 2007.